Let's go ahead and run through an example of an upstream sale of inventory over a number of periods. Let's go ahead and assume that Big owns 80% of Little and that Little routinely sells merchandise to Big. Upstream sales of merchandise for 2001 through 2004 are as indicated in the accompanying table. And looking at the table, we see that there's nothing before 2001. Let's assume that there were no intercompany sales in 2000 or 1999. 2001 was the first year of any intercompany sales. Required. Let's go ahead and prepare the elimination entries arising from these intercompany sales of merchandise, assuming that Big uses the full equity method to account for their investment. Also, assuming that Little reports earnings of $100,000 each year, what would be the income to the non-controlling shareholders in each year? These tables are always difficult to construct in a manner which is clear, concise, and unambiguous. Let's go ahead and just run through the lines and see what we're talking about. In 2001, there are goods which cost $60,000. They're sold upstream for $100,000, yielding a gross profit of $40,000. Of that merchandise, 60% was resold to a third party in 2001. The other 40% was resold the year after sale, 2002. Likewise, in 2002, goods costing $75,000 are sold upstream for $100,000, yielding a $25,000 gross profit. Of that merchandise, 30% was resold to a third party in 2002, 50% was resold the year after that, 2003, the final 20% was resold in 2004. In 2003, goods costing $96,000 were sold upstream for $120,000, yielding a gross profit of $24,000. 80% of that merchandise was resold in 2003, the final 20% was resold to a third party in 2004. And again, in 2004, nothing happened as far as intercompany sales are concerned. So let's go ahead and run through what we have to do in 2001. Step 1, eliminate this year's intercompany sales. So again, we see from line 1 in that table, goods are sold at a selling price of $100,000. So we're going to go ahead and eliminate $100,000 in sales and $100,000 in cost of goods sold. If all of the merchandise had been resold to a third party in 2001, we would stop at this point. This entry doesn't defer any gross profit. This entry has no effect on income. Sales and cost of goods sold both drop by $100,000. This entry has no effect on net income, and it doesn't adjust our inventory values at all. So again, if we stopped here, that would be a tacit assumption that all the merchandise had been resold to a third party, and that there's no overvalued inventory on our balance sheet. That's not the case though. Only 60% of the merchandise was resold to a third party. The other 40% is still on hand, which means we have to A, defer the gross profit on the unsold merchandise, and B, reduce the merchandise inventory down to its correct value. So again, 40% of the merchandise was unsold. That means 40% of that $40,000 gross profit has not been realized. So we need to go ahead and defer 40% of $40,000 or $16,000. And we do that by increasing cost of goods sold. That defers the income, and crediting inventory. That reduces the inventory from its marked up value down to its true cost. Just looking at these numbers a little bit more closely. Again, in 2001, the goods were sold upstream for $100,000. The cost of that merchandise was $60,000. So the cost as a percentage of selling price was 60%. Of the $100,000 in merchandise, 40% is still on hand at the end of the year. So 40% of $100,000 would be $40,000. That's the marked up value of the inventory. The true cost was $60,000, so 40% of $60,000 is $24,000. So what we're doing here is we're reducing our inventory from the marked up $40,000 down to the true cost of $24,000. Step 3, where we carry forward the unrealized gross profit from the previous year, this is not applicable because again, nothing happened prior to 2001. Finally, we have to get the income to the non-controlling shareholders. And again, the non-controlling shareholders own 20% of Little. So they're going to get 20% of the adjusted/realized subsidiary earnings. We look at those two elimination entries and we ask ourselves, how did these entries affect earnings from the subsidiary? The first entry was a wash. There was no effect on income from the first entry. But the second entry, there's a $16,000 debit to cost of goods sold, so that reduces our income by $16,000. So the non-controlling shareholders will get 20% of $100,000 minus $16,000, or $16,800. Okay, Okay, 2002. We have to go through the same drill. Step 1, eliminate this year's intercompany sales. And again, the intercompany sales revenue is again $100,000, so we reduce sales and cost of goods sold by $100,000. Step 2, we have to defer the unrealized profit on this year's sales. So again, looking at the 2002 line in that table, there's a $25,000 gross profit this year. 30% of the merchandise has been resold. The other 70% hasn't been sold yet. That means that 70% of that $25,000 gross profit hasn't been realized and has to be deferred. So we go ahead and increase cost of goods sold by $17,500. That's 70% of the $25,000 profit. And we reduce our inventory by the same amount. Step 3, where we carry forward the unrealized gross profit from the previous year. Again, last year we deferred $16,000 of gross profit. We deferred 40% of that $40,000 gross profit. When we carry it forward, since this was an upstream transaction, it's going to be split between the parent and the non-controlling shareholders. And since the parent since Big uses the full equity method, we're going to adjust the investment in a little account for their share of that $16,000. But again, we're taking that $16,000 unrealized gain, carrying it forward from the previous year, and splitting it 80-20 between the parent and the non-controlling interest. All of that merchandise was resold in 2002, which means that that $16,000 previously unrealized gross profit now gets realized and recognized via a reduction of cost of goods sold. Finally, the income to the non-controlling shareholders. Again, we look at those 3 elimination entries and ask ourselves, how did those 3 entries affect the earnings from the subsidiary? Again, we're going to start with 20% of the parents, 20% of the subsidiary's reported $100,000. The first entry has no effect on earnings. The second entry, we have a $17,500 debit to cost of goods sold that reduces our income by $17,500. The third entry, we have a $16,000 credit to cost of goods sold, so that increases our income by $16,000. So the non-controlling shareholders get 20% of that adjusted/realized earnings, or $19,700. Again, if this had been a downstream sale, these elimination entries wouldn't affect the non-controlling shareholders. In 2003, same drill. We have to eliminate this year's intercompany sales. This year's intercompany sales revenue was $120,000. Step 2, we defer the unrealized profit on this year's sales. And again, in 2003, there's a $24,000 gross profit. 80% of that has been realized because the goods were resold. The final 20% has not yet been realized. So 20% of $24,000 is $4,800. And we're going to defer that $4,800 by increasing cost of goods sold and reducing inventory. Step 3, we carry forward the unrealized gross profit from the previous year. If you look at the entries for 2002 on the left-hand side of the screen, we see that we deferred $17,500 from last year's sales, and now we ask ourselves, first on the debit side, the $17,500 gets split 80-20 between the parent and the non-controlling shareholders. And now we ask ourselves, has that $17,500 been realized, so we'll reduce cost of goods sold, or has it not been realized? Is it still on the balance sheet as inventory, and we'll have to reduce inventory? Well, in this case, it's split. Again, looking at the 2002 row in that table, of all the merchandise that was sold on an intercompany basis, 70,000 was unsold at the end of last year, so we deferred 70% of that $25,000 gross profit, $17,500. Of that 70%, 50 of the 70% has now been realized, so we'll go ahead and reduce cost of goods sold, so 5/7 of $12,500. The other 20%, or 2/7, still hasn't been sold, still hasn't been realized, so we have to go ahead and reduce inventory to correct that value. Then lastly, the income to the non-controlling shareholders. Again, we look at those 3 elimination entries, ask ourselves, how do those elimination entries affect earnings from the subsidiary? The first entry has no effect on earnings. The second entry, we have a $4,800 debit to cost of goods sold, thereby reducing earnings. In the third entry, we have a $12,500 credit to cost of goods sold, thereby increasing earnings. So the non-controlling shareholders will get 20% of that sum, that adjusted/realized earnings, or $21,540. Finally, 2004, and I just put the 2003 entries up there just so we can refer to them. 2003, eliminate this year's intercompany sales, not applicable. There were no intercompany sales in 2004. Step 2, defer unrealized profit on this year's sales. Not applicable. Again, no intercompany sales, no deferred profit this year. Now we do have to carry forward the unrealized gross profit from the previous year. And look at the entries for 2003. In the Step 2 entry, we deferred $4,800. In Step 3, we were still deferring $5,000. We still hadn't recognized all of the 2002 gross profit. So if you look at the two credits to inventory in 2003, there was a total of $9,800 of marked up inventory being carried forward from last year. And now the question is, that $9,800 of unrealized gross profit, has that been realized and will adjust cost of goods sold, or do we still have it? Now apparently all the merchandise has now been sold, so we carry forward that $9,800 of unrealized gross profit, and again we split it 80-20 between the investment and the non-controlling interest. And now all that merchandise has been sold, so we'll go ahead and reduce cost of goods sold by $9,800. Lastly, the income to the non-controlling shareholders, again they're going to get 20% of the adjusted/realized earnings. We look at those elimination entries, and the only entry there is the third one where there's a credit to cost of goods sold that reduces cost of goods sold or increases earnings by $9,800, so the non-controlling shareholders get 20% of $109,800 or $21,960. Just as sort of a curious point, if you go back and add up the income to the non-controlling interest over the 4 years of this problem, 2001 through 2004, you'll find that it sums to $80,000. And that's 20% of the total reported earnings of $400,000 over this 4-year span. All we've done with these elimination entries is defer the earnings in one period only to recognize them in a subsequent period. It's just affecting the timing of the income recognition rather than the absolute long-run total.